Your IEEE membership means access to insurance products featuring exclusive group rates, flexible benefit options, and portable coverage that stays with you throughout your career. Engineered to help protect your loved ones and your financial security. For more information, go to IEEEinsurance.com.
Good afternoon, everyone, and welcome to our IEEE-USA webinar, Engineering Your Wealth, 10 Steps to Building Wealth. I'm your host, Jonathan Cho. Today's webinar is brought to you by our sponsor, the IEEE Member Group Insurance Program, powered by AMBA. Joining us today is IEEE member and former engineer turned financial advisor, David Sandhu. David formerly worked for SpaceX, Raytheon, and Lockheed Martin as an engineer before he transitioned to the financial services industry. After his father passed away, David helped his mom through some tough financial questions, and that gave him the spark to pursue a career in financial planning. David is passionate about serving others and lives by Zig Ziglar's famous saying, "You can have everything in life you want if you will just help enough other people get what they want." He knows firsthand that true happiness is experienced when helping others. Without further ado, I will now pass it off to our presenter. Welcome, David. We're very excited for what you have in store for our audience today.
Appreciate that, Jonathan, and I'm very excited to be here presenting for IEEE-USA about engineering your wealth, 10 steps to navigating money. Again, my name is David Sandhu. I'm a financial advisor with Eversource Wealth Advisors. Really looking forward to this. I'm very thankful, again, as I mentioned, to IEEE-USA. I've been an IEEE member for many years, and very excited to share some information with some fellow IEEE members. As Jonathan mentioned, I was an electrical engineer for I was about 12 to 15 years there, with some time in between, and I'll share more about my backstory here in a minute. But again, I'm really looking forward to the workshop today. If you have questions, feel free to drop them in the chat box. I definitely want to make sure that this workshop is engaging, is thought-provoking. But if you have questions, that's the best way to comment kind of as we go throughout. So without further ado, let me just mention here, if you want to get access to a copy of the Engineering Your Wealth slides, if you'd like access to the Engineering Your Wealth toolkit, which includes about 25 plus checklists, flowcharts, wealth building strategies, that is all in that QR code. So if you go to that QR code page, it'll ask for whatever the best email is to send that information to. There's also what's called a Wealth Builders Assessment. And when I do this workshop for companies, it helps for people to understand kind of where they are along their journey. And there's a score that it's unique to you. So you answer some questions, and it'll give you a score based on the information that you put into that quiz. So again, if you have questions, feel free to drop them in the chat box. I'll also put, or I think maybe Jonathan can put a link to this in the comments, the Engineering Your Wealth Toolkit. So without further ado, let's get right into it. So a quick disclosure before we get started, anything we discuss is not meant to be taken as specific tax, financial, or legal advice. Everything we discuss is meant to be general information and educational in nature. I am an investment advisor with Eversource Wealth Advisors, a registered investment advisor. And lastly, this webinar is not affiliated, sponsored, or endorsed by IEEE or IEEE-USA in any way. So with that out of the way, let's get right into it. So who is this class for? Well, really this class and this workshop is obviously for IEEE members and professionals that want education on how to protect their family, maybe using their benefits, how to invest according to their phase of retirement, how to develop a financial strategy for their family. That's a big question I get a lot, like, hey, how do I develop a strategy around my family? Take full advantage of the tax benefits that you have as an employee, how to mitigate rising taxes affecting your cash flow. That's another big concern we hear from a lot of people. How to make the most of your benefits, both before and after retirement, how to minimize taxes on your retirement income distributions, and then really how to develop the peace of mind that comes from having a comprehensive plan. And so that's really the agenda. And really, my hope is that's who you are. If you have questions like this, then hopefully you're in the right place. So that's a little bit about who you are, a little bit about who I am. Again, I'm a former electrical engineer. I worked at Raytheon, SpaceX, and most recently, my last employer was Lockheed Martin, before I transitioned out into the financial services industry. I just have a couple of pictures of me here. I'm a former Skunk Works engineer, so there's no pictures of me doing Skunk Works types things because at Lockheed, right, everything's classified. And so, but I did volunteer a lot. And one of the things that I really appreciated about my engineer experience was the volunteer opportunities, especially that Lockheed Martin had. Here's pictures of me doing Habitat for Humanity, the Engineers in the Classroom program, the Dallas Stars program. Actually, this bottom picture is a picture of my wife and I. This was for Family Day. My wife actually worked on F-35 and I was in Skunk Works. And so just a little bit, just some pictures, just to give you, shed some light on who I am as a person. On the professional side, again, former electrical engineer, I created the Financial Freedom Blueprint, really going through some transitions in my life. And that really helped to help us to pay off about $100,000 of college student loan debt, to save up an emergency fund of 1 year, to give over $150,000 in charitable donations, and then to pay off the mortgage in our home. And I have the wonderful privilege of teaching hundreds of families every year how to accomplish similar types of goals fast. And so I'm really delighted to be here today. Quick backstory on me. Again, you might be wondering, David, why did you leave a career? This is probably the biggest question I get when I present for engineering organizations. David, why did you leave a career in engineering, in rocket science, right, to leave SpaceX and companies like that to pursue a career in financial services? Well, my story actually starts with my father. So this is a picture of my father and I. About 15 years ago, I took my parents on a cruise. As you can see, there's a cruise ship in the background. I asked my dad, I said, hey, Dad, do you have any investment or retirement accounts? And my dad kind of started chuckling. And he said, yeah, David, I've got 5 investment accounts that I've been putting money into over the years. And then he kind of just kept chuckling. And it didn't really hit me until a few minutes later, because I'm actually one of 5 kids. And so the punchline is, he didn't really have any investment accounts. He wasn't on track to build wealth or anything like that. He saw us as his greatest investments, which was amazing from a legacy perspective. But unfortunately, he never got to receive a return on that investment. Unfortunately, about 10 years ago, my father passed away. And so I walked my mom through a lot of tough financial planning questions, a lot of those questions that you might have right now. But I walked her through a lot of those questions, and that's really what put the spark in me to leave a career in engineering and rocket science and all of that in Skunk Works to pursue a career really in financial planning. I really wanted to help more people, like I helped my mom transition, help her go through, help her manage her finances, help her understand her finances. Education was a big part of that. And really that's what led me to start teaching more financial education classes. So I actually went part-time at Lockheed Martin, and then I started volunteering my time. I started teaching Financial Peace University, kind of just helping people understand the basics of finances, and eventually left to become a full-time financial advisor. But really it all starts with education. I think you really have to have a core understanding of how finances work in order to implement the strategies that especially we're going to talk about today, which brings us to today, which is engineering your wealth, 10 steps to navigating money. Again, if you have questions as we go throughout the workshop, please type them in the chat box. I definitely want to make this interactive as possible. And so if you have questions, feel free to use that chat box feature. So I'm going to paint the picture for you today. So we're all standing here today, right? It's August 28th. It's getting recorded today. Retirement is maybe elusive for some of you, maybe it's very close for some of you, and everybody thinks that the path to retirement is this straight line, that we just do everything right and we end up in retirement one day. Well, the reality, and what I see as a financial advisor, is that really there's 2 different retirements that a lot of people face. There's this financial freedom in retirement, and then there's this retirement crisis, right? And unfortunately, a lot of people are kind of landing up into this retirement crisis. So my hope for you today is that you will not end up in a retirement crisis, but you will be on that path to financial freedom. And again, a lot of people think that it's a linear line, that it's just a straight path to get to retirement, but the reality is it's exponential. So the longer you take to get your finances right, the harder it becomes to actually reach financial freedom in retirement. Now, some of you might be thinking, David, I'm on the green line. I'm on the path to achieving financial freedom. Others of you might be thinking, David, man, I'm way past the red line. I'm heading towards a retirement crisis. And then others of you might be thinking, I'm somewhere in this yellow line. Maybe I was saving for retirement and I was on a good path, but there was a medical emergency or someone passed away or something that kicked you off the green line and pushed you into that yellow line. So I'd actually just love to know in the chat box, do you feel like you're on the red line, in the green line, or maybe somewhere in the yellow line? So maybe just type in the chat box red, yellow, or green. I would just love to know kind of where you think you are. Do you feel like you're on the red line, the yellow line, or the green line? Would love to see kind of where your thoughts are here. A couple of people commenting yellow. I see some other comments here. I saw one that said blue. Yeah, so some people are in between a lot of these areas. And again, maybe you were on the right path, but unfortunately just got pushed off Someone said black. Okay, maybe some of y'all are there. Well, really the purpose of this workshop, and for the next hour that we're together, my hope for you is that you will make educated and proactive decisions to achieve that financial freedom that I think what a lot of people assume, to get to what I call those green line decisions. So really the purpose of this workshop is to help you make green line decisions on your path to financial freedom, so that you don't end up in this drift mode, which is unfortunately where I see a lot of people and kind of drifting into a retirement, and unfortunately it leads them to a retirement crisis, right? So anything that doesn't get measured or doesn't get managed doesn't get measured, and so unfortunately a lot of people are just drifting into a retirement crisis. So I'm going to walk you through the 10 steps, again what I call the 10 steps to building your wealth, which is this whole workshop is engineering your wealth. I'm going to walk you through this, but again I want to reiterate, you are as close as you will ever be right now today as you are to the green line. And every month, year, 5 years, 10 years that you wait, it just becomes that it takes that much more effort to go from that red line to the green line. So again, my hope for you today is to really get you back on that green line and to make educated and proactive decisions. So with that in the background, let's walk you through each of the 10 steps. I'm going to give you a high level. And again, if you haven't already, the Engineering Your Wealth toolkit, or you could have scanned that QR code. That toolkit has a copy of the slides. It also has a copy of this blueprint in there. It also has a wealth builders assessment and a bunch like 25 plus guides, checklists, and flowcharts that are specifically tailored to this blueprint, okay, that we designed. So definitely take advantage of that. But the Engineering Your Wealth Blueprint is really something that I started putting together for my own personal life, because a lot of people started asking me, hey, David, what are you doing with your finances, right? I've always kind of been a money nerd, right? Kind of the engineering, the engineer, as it were, when it comes to finances. And so I just started documenting, what am I doing, looking at my past history, and then documenting out what I will be doing in the future. And so this is the blueprint that I take my own clients through as they're getting ready for retirement, or whether they're 5, 10, 15, 20 years out from retirement. Wherever you are in retirement, this is a great blueprint to start using. So again, we're going to go through each of these in detail, but at least you could take a screenshot, or again, you can download the Engineering Your Wealth toolkit, but you'll have access to these through the toolkit slides. But we're going to go through each one, but I just want to go through a high level overview for you. So the first step is to protect your family from financial emergencies. The second one is to maximize your employer benefits. The third is to pay off your high interest debt. Fourth is to build up cash reserves. 5 is to evaluate your taxes. Number 6 is to align your investments, and I'll explain that here in a minute. Number 7 is to protect your estate. Number 8 is to save for goals. Number 9, optimize your money. Number 10, rethink retirement. And then there's a bonus one here, 11, which is really developing a blueprint. And so you're going to be able to take bits and pieces of each of these as it relates to you. The beauty of this is that you can use this for anyone, but for some of you, you might be applying more or less, kind of depending on where you are. Some of you might be saying, "Hey, David, I'm already on step 5, so let's jump to that area." But I want to cover everybody from a baseline perspective. So let's get right into it. So the first step on the Engineering Your Wealth Blueprint is step 1, protect your family from financial emergencies. Okay, and there's 3 specific emergencies that I see a lot of people missing out on. So the first one is death. The second one is disability, and the third one is high deductibles. So a lot of people are not prepared for these financial emergencies. So death, obviously, the best way to de-risk from a death perspective and to help your family is getting life insurance, right? Same thing with disability. There's disability income insurance, and then from a high deductibles perspective, the best way to recover from that is just to have what I would consider your highest deductible in the bank. So from a death perspective, there's a lot of methods there to calculate how much life insurance you might need, and obviously you can visit IEEE Insurance to go through their process. They have their own numbers that will help you calculate, but this is just a very high level baseline. So what I recommend is somewhere around 10x your income plus $100,000 per child plus any outstanding debt. Okay, so if you have any of those, if you have kids, if you have outstanding debt, just add those to the number. But really think through, if I passed away today, who would be relying on me? Would it be my kids? Would it be my spouse? Would it be my parents? And for me, that was a very real situation. If I passed away, I was providing financial support to my parents, and so that would have been a very real scenario that they would have had to deal with. Disability. So again, a lot of people don't realize, but disability can have potentially a more damaging effect than death on someone's life, because especially if someone becomes disabled, not only are they not generating income as they previously were, but now they might be a burden to their family who has to maybe stop working to take care of them. And then the third one is high deductibles. Again, I don't say you need to have $500,000 in the bank, but whatever your highest deductible is. So maybe it's your health insurance deductible, or maybe it's your car insurance, or maybe it's your home insurance deductible. Whatever that is, I would encourage you to have that set aside in the bank. Obviously, what we don't want to have happen is that you have a medical emergency and a financial emergency, or hail hit your roof, which is a very real issue here in DFW, and you have a financial emergency. So we want to make sure that you're following a right path here to protect your families from financial emergency. The second step is to maximize employer benefits. I can't tell you how many people I meet with, especially engineers, that we're working through their plan, and I ask them, hey, are you taking advantage of the employer benefits? But a lot of employers offer these. And actually, maybe just comment in the chat box. Does your employer offer an HSA, a 401k, and a Roth 401k, or maybe a match? So if they do, maybe just type in the chat box HSA, match, and then Roth 401k. I'm actually just curious. So just type in the chat box HSA, match, and then Roth 401k. Maybe one or all three, kind of just depending on what they offer. So the health savings account, I'm going to talk a lot more about those. The employer match is something that I see a lot of people missing out on. They're just, a lot of employers will offer, if you contribute 8%, they'll match up to 4%, or if you contribute 6%, they'll give you 3%. It just kind of depends on the employer, but for a lot of people, they're missing out on getting that match. So I would encourage you, make sure you're getting at least the match inside of that account. Then the Roth 401k, a lot of people miss out on the Roth 401k option. A lot of people don't realize that their employer even offers the ability to make contributions to your 401k as Roth contributions, okay? One of the benefits to the Roth 401k is there's no income limitations versus a Roth IRA. So with a Roth IRA, if you make too much money, you cannot contribute to a Roth IRA. That's not the case with the Roth 401k. So regardless of how much money you make, you can contribute to the 401k because it's employer sponsored. The other benefit is it's almost 3 times the Roth IRA limit. So if someone says, hey, I want to put more money into my Roth accounts, where should I do it? Generally speaking, the Roth 401k, at least in 2024, has a $23,000 contribution limit versus the Roth IRA, which only has about $7,000. So there's almost a 3x difference between the Roth IRA and the Roth 401k. But let's get into the specifics and why I recommend everyone take advantage of at least the HSA. So the HSA is the only type of account that is triple tax advantage. So the money goes in, it's tax deductible. The money can grow and it's tax-free. And then when you pull the money out in retirement for what's called QME, qualified medical expenses, that money comes back out to you, also tax-free. Again, this is the only type of account that is triple tax advantage. One of the benefits in this account is also you can invest the money. So very similar to a 401k, you can actually invest this money inside of the HSA. For many employers that offer this, you can do this. Again, I just put it up on your screen, the contribution limit. So for 2024, there's different contribution limits for single, for family coverage, and then a catch up if you're over 55. Now, keep in mind, the only way that you can contribute to an HSA is if you're enrolled in a high deductible health plan, so an HDHP, a high deductible health plan, okay? Again, the benefits are it's always tax-free, so the contributions, the expenses, and the investment gains, tax-free. The other benefit is it's portable. So if you leave your company, just like your 401k, you can roll it over, you can move it with you. You can do that with an HSA. And then, of course, in retirement, you can use this for, again, what's called qualified medical expenses. But the other benefit to the HSA, which a lot of people don't realize, is after 65, you can use the money in the HSA for anything and not get penalized. You'll just get taxed on the HSA. So in a very real sense, it acts very similar to an IRA. So that's a huge opportunity. And unfortunately, I see a lot of people missing out on that one. Okay, so that's the HSA. The next one is 401k plan. So I mentioned this here. There's contribution limits, again, for the 401k and the Roth 401k, but the total combined contribution limit, unless you have a special provision inside of your 401k that lets you go up to $69,000, for most people it's $23,000, okay? Now, again, if you put money into the Roth 401k or the traditional 401k, your employer is going to match that money in the traditional 401k contribution. If you're age if you're age 50 or older, there's also an additional catch-up contribution. Once you hit that age of 50 or older, you can start doing extra catch-up contributions. That's good for a lot of people, but especially if you're about to transition into retirement, my personal preference is actually pull back on the contributions to those retirement accounts and start building up a cash buffer. But anyway, we'll talk more about that in step number 10. So the big question I always get is, should I contribute to a traditional 401k or a Roth 401k? And of course, the answer is it depends, right? So it depends. Now, a lot of people are assuming, and I've heard a lot of financial advisors and I've heard a lot of tax professionals say, oh, you'll be in a lower tax bracket in retirement, so you should contribute to the 401k, which I'm not a huge fan of that blanket advice. I think especially, and maybe for a lot of engineers especially that are generally speaking higher income earners, higher savers, generally not spending as much as the general population, they will traditionally have a lot more assets sitting inside their 401k or IRA. And unfortunately, they are looking at, a very massive tax bill once they get into retirement. This is just what I see in practice, working with a lot of engineers, that once they get into retirement, they think, oh, I'll be in a lower tax bill. And then once pensions kick in, then Social Security kicks in, and then there's something called RMD, which is required minimum distributions. Unfortunately, they get pushed up in maybe even a higher tax bracket than they were when they were working in their working years. So this is not a blanket, always in the 401k or always in the Roth 401k. I think it depends based on your current income and then your projected income in the future. Step number 3, pay off high interest debt. It sounds simple, but I see a lot of people that are transitioning into retirement that just have not paid off their credit card bills, right? And unfortunately, they have this revolving charge that's just sitting there. There's 2 methods that are kind of very popular if you Google these, you can find these pretty quickly. The first one is debt snowball method, and then the second one is debt avalanche. So the debt snowball method is basically you list your debts smallest to largest, and then you pay them off in that order. And the theory behind that is, as you gain momentum, you start building up this snowball of momentum. You just continue to pay off more and more debt. The second one is debt avalanche method. This is more for the Excel type folks like me, who would say, well, let me list them highest interest rate to lowest interest rate, and then I will pay them off in that order, because I want to be paying as least amount of interest on my debt as possible. So again, whichever method you can stick to, I think is the best method for you. So that's step number 3. Step number 4, build up cash reserves. And again, in the Engineering Your Wealth toolkit, that's going to be where we talk about some of these, some of these debt payoff strategies and some building of cash reserves. It all goes back to the purpose, but I would say from a cash reserve perspective, I would prefer that people have somewhere between 3 to 6 months of expenses in their, in cash and liquid assets that they can use if for some reason they were to get laid off or have a big medical emergency or whatever. Now, as you transition into retirement, I'm going to recommend that we start building up that buffer a little bit more, mainly because of the sequence of returns risk, which I'll talk more about in a minute. But again, interest rates are kind of on the downward trend, but at least take advantage of high yield savings accounts while you still can. So that's step number 4. Step number 5, evaluate your taxes. So in our practice, we are very tax sensitive when it comes to our clients' assets. And so we want to look at these 4 tax buckets, which is the taxable money. So this is money that you're earning income on, money that you would receive a 1099 for, money that you would maybe have a gain from a short-term or long-term capital gain. And that's tax bucket number 1. Tax bucket number 2, this is tax deferred money. So this is your 401k, your IRA, your 457, your 403b, all of that is tax deferred. The third bucket is income tax free and estate taxable. So those would be things like Roth IRA, HSA, Roth 401k, that's income tax free, but it is subject to estate taxes. And then bucket number 4, that's where you use the funds from number 3 to fund number 4, and that's where it becomes income tax free and estate tax free. So those are the 4 buckets. Now let me ask you a question. Of the first 3 buckets, taxable, tax deferred, and income tax free but estate taxable, where do you think most people have their retirement account, the majority of their retirement assets? So if you were to walk up to most people on the street, would you say they would be in bucket number 2 or bucket number 3? I'll just type it in the chat box. Maybe just type in 2 or type in number 3. I'm just curious to know. If you walk to some random person up on the street, where would you say most people have the majority of their assets? In bucket number 2, which is 401ks, IRAs, or bucket number 3, which would be Roth accounts, HSAs, Roth 401ks. And yeah, a lot of people are commenting number two. And this is what I see in practice. The majority of people that I see that are transitioning into retirement, or even maybe you're 10 or 15 or 20 or 30 years out from retirement, most people have been putting funds into that tax bucket number two, that tax deferred account. Again, because we kind of hear this phrase all the time. Oh, you'll be in a lower tax bucket in your bracket in retirement. So just defer, defer, defer. But I may be a little bit controversy to that. So I would say buy out the government at the lowest tax rate you can, which I would prefer the Roth accounts. Okay. So, and again, we're at historical tax lows. I'll talk more about that in a minute, but just understand it's not blanket advice. You really need to understand what tax bracket you're in and then what tax bracket you will be in the future. So how do we move money between the tax buckets? Well, you can do what's called a contribution. So you can take money from your taxable earned income and you can defer it. So this is what a lot of people do. They defer it into their 401k, their IRA, their 457, their 403b. Now, if you said, hey, David, I really like bucket number three. That's where I want my money to be in retirement. Well, you can also do a contribution to bucket number three. You would just contribute to a Roth 401k or a Roth IRA or an HSA. There's also life insurance that you could contribute to. That's part of that income tax free, but estate taxable aspect. And there's a lot of people. Is anybody wondering how do I get money from bucket number two to bucket number three? Well, that's what is a little bit unique and what I've been talking about a lot here in the last couple of years, because tax rates are on the rise. We're going to see them with recent legislation sunsetting. We're going to see tax rates rise at the end of 2025. So in 2026, when we all wake up, all of our tax brackets are going to be just a little bit higher. And if you're curious about this act came into law in 2017. It was called the Tax Cuts and Jobs Act, TCJA of 2017. Well, all of those rates are going to expire at the end of 2025. 2026, we're all going to wake up. And actually, all of those rates are in the Engineering Your Wealth Toolkit. So for those of you that are thinking, okay, David, I've got a lot of money in my tax deferred, I'm a little concerned because I'm going to start planning now for the future. And it does look like I will be in a higher tax bracket in retirement. How do I get out of this mess, right? And there's a gentleman I'm actually doing a webinar with in a couple of weeks. He wrote a book. It's all about, he calls it the ticking tax time bomb. Okay. And so that's for some of you that you might be thinking, oh man, I want to get out of this ticking tax time bomb. Well, that's what's called a Roth conversion. So that's where you take money that you have not paid taxes on, and you can actually convert that money into a Roth IRA. So in a very real sense, you can take money from an IRA, convert it into a Roth IRA. That's what's called a Roth IRA conversion. There are other methods to do this. So the other methods are Roth IRA conversion, and then backdoor Roth IRA conversion, and then a mega backdoor Roth IRA conversion if you have a Roth 401k plan at your employer and they allow in-plan conversions. So that is actually a number of ways that you can get money from tax bucket number two to tax bucket number three. So hopefully that was helpful. So again, we're just going along different retirement accounts here, but in generally speaking, from an IRA perspective, there's two main types. There's the traditional IRA, and then there's the Roth IRA. Now I'm excluding business owners, there's SEP IRAs, simple IRAs, but for the majority of employees that have earned income, or maybe a spouse that is not working, but they can actually make a spousal, they can set up a spousal IRA. You can contribute $7,000 per year with the additional catch-up contribution of about $1,000. Now, these numbers change every year. They're usually adjusted for inflation. But the biggest question I get is, should I invest in a 401k or an IRA? Well, one thing I mentioned earlier is if you make too much money, you can't even contribute to a Roth IRA. So that's where I would lean back towards the Roth 401k if you have access to it. Now, there are other methods to get money into a Roth IRA. Like I mentioned, a backdoor Roth IRA, a conversion, or a mega backdoor Roth IRA, but there are some rules that you want to understand called the aggregate rule and some other rules. But again, I put those in the Engineering Your Wealth Toolkit. So from a tax planning perspective, evaluate your taxes is not a simple step. Okay, it's simple, but there's some complexities that come around to it. So there's a lot of different ways that you can start planning for your taxes. But I think it really comes down to these two questions, which is, what is your current effective tax rate? Okay, so that's the amount of money you paid in taxes last year divided by your income. And then where do you think your overall and personal tax rate will be in the future? These are a lot of the questions that I work with my clients through because they are concerned about rising tax rates. We've seen, and generally speaking, we see tax rates on the rise, and we know they're going to rise in 2 years. And so this is something, again, from a regulation perspective, we want to stay abreast of. We want to be mindful of how these things will affect us. Okay, I'm at kind of the midway point. So again, if for some reason you hopped on late, you can scan the QR code up on your screen. There's also a link to it in the chat box. But you can request. If you scan the QR code, you can get a copy of the slides today. There's an Engineering Your Wealth toolkit, and then there's also a Wealth Builders assessment, which kind of grades you on how well you're doing on this journey. Okay, number 6 here, align your investments. Okay, so again, we've talked about debt, we've talked about saving, we talked about emergencies. Now we're talking about aligning your investments. So I want you to start thinking through aligning your investments with your phase of investing, with your asset allocation, and with diversification. So what does that actually mean in reality? Okay, so when we work with clients, we classify them in 3 different segments here. So there's the people that are in the accumulation phase of investing. So those are the people that are more than 10 years out from retirement. Then there's what I call the critical 15. This is the 10 years before you retire up until the first 5 years after you retire, and I'll explain why here in a minute. And then this third phase, which is the distribution phase. This is where you're more focused on having income being generated and sent back to you. I really believe the 10 years before you retire, up until that first 5 years, is very critical for your retirement plan. I would say I really believe this is the time you cannot afford to make a mistake. Okay. Now, let me ask you, would you say that you are in the accumulation phase? Maybe just type in A to the chat box. Would you say you're in that critical 15? Maybe just type in C15, C15. Or are you in the distribution phase? Maybe just type in D. So type in A if you're in the accumulation phase of investing. Type in C15 if you're in that critical 15. So that first 10 years right before you're about to retire up until the first 5 years after you retire. Or type in D if you're in the distribution phase. This would be primarily people that are retired and that are drawing down their portfolio over the next 20 or 30 years. Okay. So it looks like we have quite a few people in the accumulation phase, a lot of people in the critical 15 phase. And then just a few that are in that distribution phase. Okay, so again, if you're in the accumulation phase, you are likely more focused on growth, right? So if you're 20 years old and the stock market goes up 30% and then down 30%, it doesn't really have a material impact on you, right? Because this is long-term growth money, right? So you need to start focusing on growth. If you're in the preservation phase, that's where you want to start shifting your mindset, a little bit of a paradigm shift, to start thinking about preserving your capital. So, hey, I need to start thinking through. I don't necessarily need the hottest stock or the biggest growth fund. I need to start focusing on preserving the capital, the money that I've saved for retirement. And then if you're in the distribution phase, you're really focused on income. You're really focused on, hey, how can I generate income from this portfolio that I've saved up for? So from an investing perspective, I would say there's two big keys. Okay, but what I'm talking about here is asset allocation. Okay, so asset allocation, generally speaking, is the mix between equities and fixed income, or stocks versus bonds. So if you log into your 401k account, you might see things like you're in a 60-40 portfolio, and what they're meaning by that is you're a 60% equities or stocks, and then 40% bonds or fixed income. Now, there's a couple of keys. The first one is asset allocation. So understand that generally speaking, if you're in the accumulation phase of investing, you probably want to be more focused on kind of getting towards more equities and less maybe fixed income exposure. And then if you're more focused on preservation, you might want to be shifting that fixed income exposure up. And then if you're in the distribution phase, there actually is a lot of strategies in the distribution phase that we use, but you might be somewhere a little bit more conservative when it comes to your phase of investing. You might have a little bit more conservative asset allocation. A lot of times I see people missing out on is I might meet a 25-year-old and they filled out a risk profile questionnaire. Has anyone filled a risk profile questionnaire out online? It might be called a risk tolerance questionnaire, and it's like 5 questions, and then all of a sudden it's like, okay, here's your investments for the rest, for the next 50 years. Well, you need to reevaluate, right, over time. The second key is diversification. So inside of the asset allocation, so we know your asset allocation, maybe it's 60-40 or 50-50, but inside of that, you need to start thinking through what am I actually invested in? Am I invested in small cap or mid cap or large cap? Am I invested in emerging markets, or am I invested in the US equities or global emerging bonds, right? So there's diversification inside of the asset allocation that you need to make sure that you're taking advantage of. It's really those people that have a diversified portfolio that in theory, are not as worried about, these huge market downturns, especially when, 2 or 3 stocks take a tumble. It doesn't wreck your entire portfolio. Now, we've seen in recent years these kind of, the FANG stocks, the Facebook, Amazon, Apple, Netflix, Google, they have a large percentage of the S&P 500. So for many people, that is a big part of their overall portfolio. So generally speaking, again, just realign your investments with your phase of investing, with your asset allocation, and then with a diversification that suits you and your family. Step number 7 is engineering your wealth. Now, when it comes, is protecting your estate. When it comes to protecting your estate, there's a lot of ways that you can protect your estate. But in general, what I see is documents, directives, and designations. And if you downloaded my Engineering Your Wealth Toolkit, you'll see that on the bottom there. It says documents, designations, and directives. And I think that's so important because I see so many people that have, they'll say $500,000 or $1 million or $2 million or $5 million in their 401ks, IRAs, what have you, and then they're not protecting what they've saved, right? So they don't have a capsule around their assets so that if something were to happen, they might lose a lot of money towards taxes or towards probate or towards attorney's fees or whatever. They're not protecting themselves. So at a very high level, I would encourage you to consider some of the documents that are important. So authorizations, right? Advanced healthcare authorizations, advanced healthcare directives, powers of attorney, healthcare power of attorney, financial power of attorney. Estate plans, right? So do you have a will-based estate plan or a trust-based estate plan? And also consider, a lot of employers offer in their employee assistance program some legal protections or legal services as part of their employer benefits. So think through, hey, do I have this? And a lot of times you have to sign up for it during open enrollment, but start thinking through, is this something that I have access to? And then start thinking about beneficiary designations. I'm working with someone right now that they had been working at this company for about 30 years. And when they originally signed up at the company, they logged into their 401k and they set their mom, because they were single, they set their mom as their beneficiary designation. And when we met, 30 years later, I said, hey, why is your parents on here as your beneficiary designation? And I said, and then the wife said, yeah, why is that? And that's because they hadn't updated their beneficiary designation. So definitely take time to start reviewing your estate plans. And if you don't have an estate plan, definitely start considering, who would be affected if I were to pass away? Would things keep running smoothly in my house? I'm married and I have 2 young daughters, and this is something I think through a lot. These were very hard questions that I had to answer, but I'm here to push you and say, definitely consider how your documents, your directives, and your designations will impact not only your family, but the next generation. Okay, and then the next one here is save for goals. And so in the Engineering Your Wealth Toolkit, I put in there the master list of goals. And so for some of you, it might be your goal, your biggest goal might be retirement. It might be a house, it might be a car, it might be a kid's college, whatever that is. Name the goal, specify the amount, and then set a date. I love that quote that says, what gets measured gets managed, right? So start thinking through, how are we going to accomplish these goals? And then what is the date we want to accomplish? And then how much money, right? And kind of create a sinking fund to get to that amount of money. Once you get there, then you'll be a lot happier. You can look back and say, I accomplished this goal. There's another goal that we accomplished. And so that's step number 8. Step number 9 is to optimize your money. And yeah, thanks for commenting here. If you have questions, definitely put them in the chat box. I see I've missed some comments, so sorry about that, but here's one. My mother didn't update the beneficiary designation and it caused problems when she passed. Yeah, thanks for sharing that, Randall. This is a big issue. A lot of people, they'll, especially if there's mixed or blended families. So sometimes, and I've seen this before, the husband he'll be married and then get divorced and then have another marriage, but he never updated his beneficiary designation. So his ex-spouse got all of the money from the 401k, because the way a lot of these funds get transferred is they just look at, the 401k company just says, okay, it says to go to John Smith. We're going to cut the check to John Smith. They don't look at any wills or trusts or any other documents. It has to be whatever's on the beneficiary designation. Okay, number 9 is optimize your money. So there's a lot of ways to optimize your money. The first one is, I would say, start automating your money. Okay, so this would be, automatic bill pay if you can pay your bills online. This would be automating your contributions to your 401k or IRA. Also, start automating your incremental contributions. So a lot of 401k providers will give you the opportunity to say, when you sign up for your 401k or when you review it, they'll say, hey, would you like to every year increase your percentage by 1%? And that's a great way to automate your money, because it helps keep you away from lifestyle creep. The second one here, tax planning. Again, I mentioned this before, and I put the Tax Cuts and Jobs Act comparison guide inside the Engineering Your Wealth Toolkit. But keep in mind, in 2 years, we're going to see tax rates rise. So what are the opportunities that you can start optimizing your money for right now? One of them might be Roth conversions. I actually do a whole nother webinar called Your Roth Roadmap, and we go deep into Roth conversions because so many people are missing the boat on taking advantage of their lower income bracket right now. So Roth conversions is definitely a great way to optimize your money for at least for the next 2 years. Tax loss harvesting. I don't know if you've heard of that, but basically that's a way that if you have a capital loss in one of your accounts, a non-qualified, non-retirement account, if you have a loss, you can actually harvest that loss against some gain or carry it forward. So that's another way to optimize your money. Obviously, optimize your investments. So when we work with clients, one of the things we're looking at is not only the investments that they're invested in, so the funds they're invested in, but in what account are they invested in, right? So it not only matters what funds you're in, but what account are those funds in, because some funds are not very tax optimized and some are more tax optimized. So we want to make sure we're not unexpectedly or artificially creating tax issues or paying taxes that we don't necessarily need to. And then from an estate planning perspective, start thinking through, are there designations I need to update? Are there planning opportunities that I need to start considering with the Tax Cuts and Jobs Act of 2017 that's expiring here at the end of 2025? Keep in mind, the estate gift tax exemption exclusion is going from about 13.6 million to less than half. It's about $6.5 million. So it's a lot less than it is right now. Now you might be thinking, David, I don't have anywhere close to 13 million or even 6 million. But keep in mind, that's the gross value of your estate. So it's your 401k, your IRA. And keep in mind, you might not have that now, but let's say you have 500,000 or $1 million or $2 million in your 401k IRA. What will that be in 20 or 30 years? And then add that to any life insurance, add that to any of your property value, all of your assets. That's what the gift exclusion will be against. And then from a generosity perspective, keep in mind, there are more tax efficient ways to optimize your money. Two that come to mind from a generosity perspective are donor advised funds. And then the other one is qualified charitable distributions. So I just did a workshop last month in Phoenix for the IEEE Foundation. So quick plug for the IEEE Foundation. If you're charitably inclined, if you are already thinking, hey, there's going to be so much money here I don't need, start thinking through, is a donor advised fund a good option, right? Is this a good option to be more charitably inclined, but also have a little bit of a tax benefit there? The way a donor advised fund works, and this is one huge way to optimize your money, is if you, let's say you have a large income one year because you have some non-qualified stock or some big bonus, and you can actually gift money to a donor advised fund, get the tax deduction in the current year, and then you can actually invest that money in the donor advised fund. You can actually invest it in the market. Now, once you give it to the donor advised fund, that becomes the assets of the donor advised fund. And so, it's up to you to start giving it to charities. The other way is through qualified charitable distribution. So if you're already charitably inclined, start thinking through, could I gift money from my IRA directly to the charity so it doesn't even come up on your taxes? That's another way to optimize your money from a tax perspective. So I'm not keeping a close eye on the chat here, but I see a couple of questions here. Okay, talking about probate. Yeah, there's a lot of ways that you can optimize your estate plan. I see, and definitely, this is not legal advice, so consult a qualified estate planning attorney in your state because they're different based on the state. So again, this is not legal advice. Definitely consult a qualified estate planning attorney when it comes to probate and pour over wills and trusts and will planning and all of that. Okay. Number 10 is to rethink retirement. I'm going to spend a little bit more time here than some of the other slides, but I want us to start rethinking, reframing retirement. And the first way I want you to start rethinking it is, a lot of people view retirement as a light switch. So it's either on or off. I'm either not retired and then I am retired. What I see in practice and with working with a lot of people that are transitioning, making this shift into retirement, is that I would much rather see people phase into retirement. So if at all possible, ask your employer, hey, can I work part-time at my current employment? Actually, I don't know if I mentioned this, but when I was at Lockheed Martin, I actually went part-time to transition out of engineering into financial services. I asked my manager, he said, yeah, you seem really passionate about this. And I actually reduced my hours there. I kept my full benefits, which is fantastic, but I just reduced my hours. So start rethinking retirement to not be a light switch, but more of a gradual glide into it. That, I think, a lot more people will, especially, maybe just type in the chat box, how long have you been an engineer? I'd just love to know. because especially maybe just type in the year, maybe just type in 20 years or 30 years, how long have you been an engineer? Just type in the number in the chat box. For some of you that have been engineers, 20, 30, 40 years, I was an engineer for, including my internships at Hewlett Packard and NASA. I did 20 years of working as an engineer. It's very, very hard, in my opinion, to just cut loose and just say, all right, I'm turning my engineering brain off. I know from personal experience that's not how it works. Okay, so from an engineer's perspective, from one engineer to another, let me encourage you. Make sure you're retiring to something, not retiring from something. Okay, so if the whole purpose of retirement is just to get out of a job or get out of a job, make it more exciting. Make sure that you're retiring to something. Start rethinking what retirement actually means. I actually do a whole nother workshop called Engineering Your Retirement, and that's the whole crux of that whole workshop is to reframe retirement as not a, okay, I'm finally retired. It's no, retirement is a time to re-engage, to get reinvigorated with maybe more time, more complexity, more assets, more volunteer work. But I also want you to rethink retirement from a risk perspective. Okay, so we talked about kind of the non-financial side. Let's talk about some of the financial aspects. Here are some of the key risks that I see people that are just missing out from a retirement perspective, right? They think, hey, I've got this massive 401k, and thanks everybody for commenting. I see a lot of people saying, 30 plus years, 35 years, 33 years, 45 years. Yeah, there's a lot of people that have been an engineer for a long time. Here are some of the risks that, again, you have to paradigm shift from accumulation to this preservation, critical 15 type of mode. And so these are the key risks: inflation, medical care, long-term care, Social Security and regulation, tax rates, and market volatility. So I'm just going to go quickly through them, and I want you to just keep in mind some of these might be more applicable to you, some of these risks might be less applicable to you. So again, a lot of people that commented 20, 30, 40, 50 years, these are good. These are the risks that you're going to start seeing more and more as you get closer to retirement. The first one is inflation. So the Bureau of Labor and Statistics, they have this rate of inflation. Now, if you can notice here, there's these blue bars and then there's these yellow bars. Well, the blue bars, this is the average rate of inflation for the average consumer. But there's a separate yellow bar here for the average rate of inflation for seniors, so people about to transition into retirement. And you might notice that there's two areas that are different. They're higher than the blue bar, and that's housing and that's medical care. And a lot of people are assuming that their medical care and housing expenses will be the same as they transition into retirement. But they're actually, what the data says is that the rates of inflation for these two areas are going to be substantially higher than they were for you in your working years. So this is not something you want to just bat your eye at. Another risk is healthcare. According to Fidelity, they do a study every few years. In 2021, they said an average retired couple age 65 needs about $315,000 saved after taxes in order to get through retirement. Okay, so this is a big number. Keep in mind, this doesn't include dental care and this does not include long-term care. So where does all this money go? Well, this goes to generic drugs, branded drugs, specialty drugs, co-payments, co-insurance, Medicare premiums, which I'm going to talk more about in a minute, Medicare Part B and Part D premiums. But keep in mind, this is for health care. This is not for long-term care. And this does not include dental care, which according to the Society of Actuaries, the Society of Actuaries does a lot of studies. They're money nerds to their core. They're the ones that tell you based on, they're the ones that do the IEEE insurance, when they think you're going to die, and they do all those rates. If you look at actuarial tables, that's the Society of Actuaries. They're the ones that look at these numbers, and this is what they've come up with. They say that dental care is one of the biggest shocks in retirement. People are just not prepared for the dental care expenses in retirement. So from a healthcare perspective, it's definitely something you want to start thinking through. From a long-term care perspective, the ACL came out and said someone turning age 65 today has almost a 70% chance of needing some type of long-term care services and support in their remaining years. So it may not be a matter of if, but matter of when you might need long-term care. So again, not something you want to neglect when it comes to long-term care planning. Social Security, I think there's like 500 ways to file for Social Security. I think you can Google it. It's like 567. But there's mainly three different times that people will file for Social Security. It's early. They'll file for Social Security early. At 62. They will file at either their full retirement age, which again, it might be 66 or 67. It depends on the year you were born. Or they may file late at age 70. And people are always asking me, hey, David, how can I maximize Social Security? Well, the easiest way to maximize Social Security is just wait till age 70. That's when you will get the highest payout. There's something called delayed retirement credits. And basically every year you delay from age 62 all the way up to 70, it's about an 8% bump in pay against your Social Security benefit. And then if you take Social Security earlier than your full retirement age, there's a reduction in that amount. And if you're continuing to work while you take Social Security prior to your full retirement age, there are also some reductions in there. So it's not, again, this is a risk that a lot of people are just thinking, oh, I'll just, the Social Security said I'll get this amount of money. That's how much I'll get. There are differences based on how much money you're making when you file for Social Security. There's a lot of different strategies there. The next one here, from a regulation perspective, start thinking through every year the Social Security Administration comes out with their kind of State of the Union report here. And every year for the last several years, they've been saying basically the same thing, which is, hey, in 2034, now I think this number is going to get pushed out a year or two, but they basically saying, hey, in 2034, we're not going to be able to pay the stated benefit on your full retirement age Social Security benefit amount. We're going to be able to pay about 78, roughly 78% of whatever we said on that amount. So this is a big concern for people that are transitioning into retirement, that the Social Security Administration will adjust their benefit. Now, I just read a book called 100 Myths and 100 Facts of Social Security, and it was actually from a gentleman who did the Social Security. It was from a gentleman who was a Social Security director for many, many years there. And a couple of the things that he mentioned in the regulation aspect were changing things like pushing out full retirement age or doing means testing with Social Security. I don't know what they're going to do, but know that that might be something we need to start rethinking from a retirement perspective. Okay, from a regulation perspective, I mentioned this before. Some of the big pieces of legislation that have recently changed, I put up on your screen, but the Secure Act, both the 1.0 and 2.0, have changed a lot of things. So the RMD right now, the required minimum distribution age, which is the age at which you have to take money out of your 401ks and IRAs, that age right now is age 73. Okay. Now, a couple of other things that they changed, you could basically roll over a 529 to a Roth IRA. The other big one was an inherited IRA 10-year rule. Okay. So if anyone has experienced this, maybe just type in inherited IRA. But for those of you that have inherited an IRA since 2020, you are subject to this. So basically, the way it used to be is the IRS said, oh, someone passed away and left you $1 million in their IRA. You can take out all of that money over your lifetime. The government said you can't do that anymore. You have to take it out over 10 years. If there's any guesses on why that is, type it in the chat box. I'd be curious to know what you think. The second one is the Tax Cuts and Jobs Act. Okay, so again, I mentioned this already, but the sunset provision ends in 2025. So keep in mind that in basically in 2026, we're all going to see higher tax rates coming up in the future. So keep in mind how these might or maybe will affect you. Okay, so now next one here, tax rate. We are at very historic lows from a tax rate perspective. So when it comes to taxes, again, a lot of people are assuming that they're going to be a lower tax bracket in retirement. But the way I see this is we are at historic lows. So we really don't have anywhere else to go but up, in my opinion. That's just my personal opinion. We're at historic lows. So the top federal tax rate right now is around 37%. This is going to get adjusted again here in 2026. Our tax brackets are going to go up. But keep in mind how tax rates will affect you in the future. So how do tax brackets and rates affect you, right? So again, taxes and regulation is another way. Yeah, a couple of people are commenting that government needs revenue. They can collect taxes sooner. Exactly right, Dwayne. Greg, yeah, that's the exact right answer. That's what I think too. If they take money out over 10 years versus your lifetime, they can collect taxes sooner. It might also increase the tax amount that you would pay because you're potentially working and then having to pay more on taxes. So how do tax rates and brackets affect you? Well, there's 6 different ways. The first one is income taxes. The second one is capital gains, Medicare premiums, RMDs, taxation of Social Security, and estate taxes. Let me break each one down for you. Income taxes, we are all familiar with. We all pay federal income taxes and or state income taxes based on the state you live in. Capital gains, so if you have a piece of property that you sold, let's say you had an appreciated stock or an appreciated piece of real estate and you sold it and you had it for 1 year or longer, that would be subject to long-term capital gains tax rates. If you held it for a year or less, it would be subject to your federal income tax bracket. The third way is through Medicare premiums. And for those of you that are within that critical 15, if you said, hey, I'm in the critical 15, this is where you need to turn your ears on here. Medicare premiums. So Medicare Part B and Part D, especially if your income is over certain thresholds, you will start paying Medicare premiums based on your income. And that number is based on your income from 2 years prior. So if you make more money, they start charging you more for Medicare Part B and Part D, and it's not marginal. So once you just get into that, if you're $1 over that bracket, you get pushed into the next bracket. Another way that tax rates affect you is through RMDs, required minimum distributions. Again, a lot of people don't realize RMDs is called required minimum distributions, but it's, at least right now, it's 73. It's going to get pushed to 75. This is the age at which you must take your money out of your 401k or IRA. You don't have a choice. It's required and it's mandatory, and you have to do it, or else you get a penalty. So this is, again, keep in mind, a lot of people think, oh, I'll be in a lower tax bracket in retirement, but then they have Social Security income come in, then they have pension, and then they have RMDs come in, and that increases their income, which can affect your Social Security, the taxation of Social Security. A lot of people don't realize Social Security is subject to taxes, and the rates are in that Engineering Your Wealth toolkit. Social Security is subject to taxes based on how much money you make. But if you make, basically, if you're married, filing, and jointly, and you make over $44,000, excuse me, if your combined income is over $44,000, part of your Social Security will be subject to taxes, okay? And then finally, estate taxes. I think Benjamin Franklin said it best. Nothing in this world is certain except death and taxes. So keep in mind the lifetime gift tax exclusion is reducing to about $6+ million here in about 2 years. So again, total value of your estate when you pass away, on the day you die. You might not be there right now, but you might be there in 20 or 30 years. Again, keep in mind the 3 phases of investing. I'm specifically talking to people in that critical 15, those 10 years prior to retirement up until the first 5 years. The reason this is important is because what I call the sequence of returns risk. Okay, so for those of you who are not familiar with this, let me paint you the picture. Dave retires at the start of a bull market and retires at the start of a bear market. They both have $500,000 invested in the market, and they both take out $30,000 withdrawals every year. As you can see, unfortunately, Anne experiences what's called a negative sequence of returns, and she eventually just runs out of money here in 2013. Now, I know people don't just run out of money in retirement, but the reality is you need to start thinking through, what is the sequence of returns that I will experience potentially inside of my own retirement years? Of course, take advantage of catch-up contributions while you can if you're over 50, and then if you're over 55 for the HSA. Keep in mind, though, as you transition into retirement, I prefer my clients to have a little bit more liquidity inside of their accounts. And then step 11 here is, this is a bonus, develop a blueprint. And I would say your blueprint needs to be written down. Maybe it's part of the overall blueprint that we went through today. Make sure it includes your income, your investments, your healthcare, your taxes, and your estate or legacy plan. Make sure it's phase-based, so it's different if you're in the accumulation phase, the preservation phase, or the distribution phase. It involves a paradigm shift from ROI, return on investment, to return on income. Okay, so there's a little bit of a paradigm shift. And then make sure it's principles based. Okay, so no investment decisions outside the context of a plan. Your plan should determine the products that you're purchasing in. Don't let your portfolio take a hit. HIT stands for healthcare, inflation, and taxes. Protect your income, grow the rest, and then finally, financial peace comes from having a plan. And so that is the building your wealth, engineering your wealth blueprint. We've gone through a lot. So if there are questions, please feel free to throw them in the chat box. And again, if you haven't already, download the Engineering Your Wealth Toolkit, the copy of today's slides, and then the Wealth Builders Assessment. Jonathan, I believe, has put a link to my LinkedIn in the chat box. I would love to connect with you on LinkedIn. That's where I'm most active and where I post the most.
All right. Fantastic, David. Thank you so much. So folks, know that was a lot of information to take in. Unfortunately, we are nearing the end of our time, but we're happy to take a few questions. Seeing a couple right now, actually. David, first, our question from Ebony. Does the bucket method help reduce the risk of sequence of returns?
Okay, this is a great question, Ebony. So yeah, I actually do another workshop called Retirement Income Planning, and I talk about 4 different quadrants. And there's 4 different ways based on how you invest in retirement. There's the all stock market portfolio, there's the all stable income portfolio, there's the 3-phase portfolio, and then the 3-bucket portfolio. And each of the way you invest in each of those is a little bit different. But if you're going to develop a bucket method to navigate sequence of returns, I would just say make sure you have enough cash or fairly liquid and safe money set aside to manage against the negative sequence of returns that you may experience. A perfect example, if someone retired in 2007, 8, 9, right, they would be like, hey, don't invest in the market because it's going to crash, right? That would be their experience. And it would be true for them, but not true for everybody. So it depends on what's right for you.
Fantastic. Thank you. And thanks for the question, Ebony. Mike asks, what is the max rate for Medicare premium?
Yeah, thankfully I don't have to memorize these. They're actually inside of the Engineering Your Wealth Toolkit. There's a whole list of brackets in there. But yeah, there's a max bracket, and then there's the max premium that you'll pay. It's inside of that. If you're looking at it right now, it's on the page that says important numbers. That's the page you want to be looking at.
All right. So, folks, unfortunately, we are out of time. I know we could have gone on and on about this. Again, if you would like to reach out to David for questions or consultation, we have included his information in the comments and chat section. We'll also be sending it out to everyone in the post webinar live stream feedback form as well. David, thank you so much for joining us today and giving your expert insight on how each one of us can engineer our own financial success. It's a lot of information, and I'm going to try to learn it as best I can. Gonna definitely take advantage of that Engineering Your Wealth toolkit. But really appreciate having you today with us.
Awesome. Thanks, everyone. Bye-bye.
And before we end things off today, I have a few announcements. First, pardon me, give me 1 second. So IEEE-USA is still seeking nominations for the 2024 IEEE-USA Awards. Every year, the IEEE-USA Awards are given to recognize professionalism, technical achievement, and literary contributions to public awareness and understanding of the engineering profession in the United States. You can find the details on each award, eligibility, and nomination process on our website. The link has been provided in the comment section. We'll also be premiering our IEEE-USA Awards ceremony tonight at 8:30 p.m. Eastern, recognizing our 2022 and 2023 IEEE-USA recipients, and we would love to have you all join in on the celebration. Next, IEEE-USA has opened up registration for 2 new upcoming events happening this fall. The first is the IEEE-USA Packaging Chips with Chips Summit on October 17th in Scottsdale, Arizona. This one-day summit will bring together leading thinkers from the chip packaging and design companies, along with government policymakers, to discuss the semiconductor chip packaging industry in light of the historic CHIPS Act and the Materials to Fab Center coming to Arizona State University. If you are an industry leader in and out around the computer chip manufacturing industry who wants a better idea of how the CHIPS Act will affect your businesses, this summit is definitely for you. The second event is the IEEE-USA Innovation, Workforce, and Research Conference, or iWork for short. Continuing on the successes of the previous iWork conferences in Arkansas and South Dakota, IEEE-USA will be hosting its next event in Huntsville, Alabama this December 3rd through the 4th, with focus on aerospace and defense. This event will give you the opportunity to meet with potential partners from the U.S. federal agency and to learn more about how you can contribute to Alabama and the Southeast innovation ecosystem. And it's definitely an event you don't want to miss. And finally, a word from our sponsors, the IEEE Member Group Insurance Program, powered by AMBA. AMBA specializes in providing tailored insurance solutions for IEEE members. Whether you're seeking health, life, or disability coverage, AMBA has you covered. Visit the IEEE Member Group Insurance Program website to explore the benefits and options available to you. If you enjoyed today's webinar, don't miss out on our extensive catalog of presentations available on our websites for viewing pleasure. And finally, please remember to like and subscribe to our channels and stay tuned to our social media for future daily updates. Have a great day, everyone.
Your IEEE membership means access to insurance products featuring exclusive group rates, flexible benefit options, and portable coverage that stays with you throughout your career. Engineered to help protect your loved ones and your financial security. For more information, go to IEEEinsurance.com.